On the bustling factory floor, every single minute of unexpected downtime or batch of wasted ingredients significantly erodes the bottom line. Consider a typical regional pizza plant that budgets for $1 million in profit, but only actualizes $800,000. Our mission is to track the precise movement of that missing $200,000. Identifying the source of the loss requires an operating profit variance analysis, the mandatory corporate autopsy performed when actual performance deviates from the approved budget. This chart maps the entire variance hierarchy. At the top is our missing $200,000. Every dollar of that variance originates from one of these two primary pillars. Cost variance tracks the operations side of the business. It measures whether we spent more than planned to produce the product. Sales margin variance tracks the market side. It determines if we earned less revenue than projected from our customers. By bifurcating the business into operational spending and market earning, we take the first logical step in assigning strict accountability for the loss. We investigate the factory floor to see if production inefficiencies are responsible for the missing profit. The operations side of the tree uses a universal formula: standard cost minus actual cost. A positive result indicates a saving, while a negative number represents a loss. The first category is direct material variance. Material variance splits into two distinct failures: price and usage. Price variance measures if procurement paid too much for flour, while usage variance captures if the machines dropped raw dough on the floor. Usage variance breaks down further. Mix variance occurs when workers use incorrect input ratios, like applying too much expensive cheese. Yield variance measures output efficiency, triggering when the plant produces fewer pizzas than the recipe dictates for a batch. We then move to the human element, direct labor variance. Labor mirrors the material logic. Rate variance is the difference in hourly pay, and efficiency variance tracks how well the crew works compared to the standard time allowed. Efficiency splits into gang and sub-efficiency. Gang variance highlights scheduling errors, such as using expensive senior chefs for tasks requiring junior prep cooks. Sub-efficiency variance captures pure productivity loss, when the crew simply works slower than the standard allows. This side of the tree proves that a cost blowout can be mathematically traced to a specific buyer paying too much, a machine wasting inputs, or a manager scheduling the wrong crew. Beyond tangible materials and labor, we must account for the invisible burdens of the factory, the overheads. Variable overheads follow the same split as direct labor, measuring what we spent on utilities versus how efficiently those resources were used during production. Fixed overheads require a different set of rules. Costs like factory rent do not scale with pizza production. Expenditure variance is simple. It tracks if the landlord raised the rent. Volume variance, however, introduces the concept of volume absorption. Volume absorption is the process of allocating fixed costs to each unit produced. To justify the rent, the plant must push enough pizzas through the factory to absorb those fixed costs. Capacity variance asks if the machines were actually running during all available shifts. Efficiency variance asks if those machines were producing pizzas at the speed required to fully absorb the rent. This branch reveals if the plant's infrastructure is a competitive asset or an unabsorbed financial anchor. If the factory floor is efficient, we must look outward to the market and investigate the sales team's responsibility for the missing revenue. On this side of the chart, the math flips. The formula is actual margin minus budgeted margin. A higher actual number here is favorable. We divide sales performance into two questions. Did we discount pizzas to secure sales, or simply sell fewer overall? Within volume, mix variance identifies if we sold high volumes of low-profit cheese pizzas. Quantity variance captures the total drop in units, regardless of type. When total quantity drops, we must determine if the sales team is failing or if the market itself has shifted. Market size variance captures macroeconomic shifts, such as a national diet trend reducing total pizza demand. This is an external factor beyond the local team's control. We contrast this with market share variance, which measures if a local competitor is stealing our specific customers. This indicates a failure of our competitive offering or sales execution. This final branch isolates macroeconomic chaos from actual competitive performance in the trenches. The complete variance tree provides a mathematical map of the business ecosystem, connecting localized operational events to the final profit figure. Because of the cascade of addition, the sum of the variances in the bottom row will mathematically equal the top operating profit variance. The model enforces exact reconciliation. Material is price plus usage, labor is rate plus efficiency, fixed overhead is expenditure plus volume, and sales volume is market size plus market share. Standard costing removes ambiguity from corporate reporting. By following this diagram, management accountants transform raw operational data into precise insights that trace every dollar of variance back to its specific source.